Hello and welcome to the Davidson Institute's recorded webinar, Measuring Financial Performance. This webinar follows on from Understanding Financial Statements. But not to worry if you missed that one though, you can always view it on demand from the Davidson Institute website as well. Measuring financial performance takes the next step in understanding the financial side of your business. Now, it's been my experience that many people go into business with a passion for what they do or sell, but they often have little or no formal financial management training, which means that this part of the business is often left up to someone else to take care of. Now, it's also been my experience that with just a little more understanding of the numbers, business owners are able to make more effective and confident decisions in the day-to-day running of their business. So let's start by recapping on the financial statements that we had a look at in Understanding Financial Statements, because this is where we're going to source the information to help us measure financial performance. Now, firstly, the balance sheet, which, if you recall, is simply a statement or snapshot of the financial position of a business at a particular point in time. It shows all of the assets that a business owns and where the money came from to acquire those assets, namely in the form of liabilities and net worth. And we can see here that Anna's Guest House and Gift Shop, that the business has grown rapidly over the past few years, acquiring more assets and taking on more liabilities. The income statement then shows the financial performance over a period of time, recording the income earned, the expenses incurred to earn that income, and the profit or loss that the business has made. Now, the income statement on the screen also shows us that Anna's Guest House and Gift Store has grown its sales rapidly over the past few years, but that her profits are not. So we're going to delve a little deeper today and use some financial ratios to measure more effectively Anna's financial performance to help identify what might be causing Anna's declining profitability. So as I said, today we're going to use some financial ratios to measure Anna's financial performance. Now, don't be alarmed by the thought of ratios because they really are quite straightforward. They simply compare one number with another to tell us a story, just like the stats of your favourite sports team. Now, there are literally thousands of ratios that we could choose from to measure financial performance, but the ones I'm going to show you today are the key measurements for most businesses. Now, firstly, though, we're going to look at the financial operating cycle. And if you recall from Understanding Financial Statements, this is the model that identifies how money flows through the business and illustrates for us the relationship between the balance sheet and the income statement. Then cash flow is absolutely critical for any business. So we're going to have a look at the working capital cycle and measure how efficiently the cash is flowing. And then finally, we're going to put our measurements into a scorecard to see how efficiently the business is operating. So let's start with the financial operating cycle. Now, the financial operating cycle is a cycle that operates in every business, no matter the size, the industry, whatever. And when a business owner understands how their business's financial operating cycle works, then they're much better informed and can make more effective financial decisions. Now imagine for a moment that we're just starting out in business. We break out the piggy bank and put as much money as we can towards the business. Our contribution to funding the business is called our equity or net worth. Now this is the money from our own pockets. Now we then combine that with the money that we borrow as liabilities. And then together, our money and the money that we've borrowed make up the resources that we have available to operate our business. And we do that by purchasing assets. So we purchase these assets to operate the business, and to do so, generate sales. Then we have a series of expenses, which if managed well, then leaves us a net profit. Now, in effect, our profit serves three masters. Firstly, it serves the business by helping us to purchase more assets. Secondly, it serves our creditors by helping us to reduce how much we owe them. And then finally, it serves us as the owners of the business or investors in the business by paying us a dividend. So used properly and in the correct proportions, we can successfully grow our business in such a way that we can avoid some of the more strenuous growth pains. Now, by understanding this flow of funds through a business, we can see that everything is interconnected and that the growth in profits that, of course, we're all chasing is going to impact on other parts of our business as well. Now, what you may have recognized too is that across the top of the diagram there is our balance sheet. And down the left-hand side, of course, is the income statement. And we can see how the two are now interrelated. Now, I sometimes refer to this as the engine room of a business. And the engine needs to be kept turning over smoothly and efficiently to create a sustainable business. It makes sense then that we would want to know how efficiently this cycle is turning over. So bring in ratios. So to measure how efficiently our financial operating cycle is turning over, we want to look at things like, how efficiently have I funded the assets? Is there more of my money invested in the business or my creditors? Then how efficiently am I using those assets in generating sales? How effectively am I turning those sales into a profit? And then finally, how does this stack up in terms of a return on the money that I have invested in the business? So let's start with, how efficiently have I funded the assets, or the debt to worth ratio? Now this ratio compares the amount of net worth, that is the owner's money, with the amount of liabilities, that is our creditor's money. Now having the right balance here should mean that the owners are getting a reasonable return on the funds they've invested in the business without taking on too much risk and having the added costs by relying on too much debt. It's calculated by dividing total liabilities by net worth. Now in Anna's case, this is $400,200 divided by $260,100, which gives us a debt to worth ratio of 1.5. Fantastic, is it? What is this ratio actually telling us about the business? Let me introduce you to a sentence that will become your absolute best friend when talking ratios. It's the sentence that helps to make sense of the story that the numbers are telling. So the sentence goes, for every dollar of bottom, there is X of top. I'll say that again, for every dollar of bottom, there is X of top. So let's apply that to the debt to worth ratio, which says that for every dollar of net worth, what's on the bottom, there is X of total liabilities, what's on top. If we then apply that to Anna's ratio, it tells us that for every dollar of net worth, there is $1.50 of liabilities. Or for every dollar that the owners have invested, they've borrowed $1.50. Now taken in isolation, this is a reasonable level of debt to worth. Should it get too much higher, then this might indicate that the business is becoming more heavily reliant on debt, which of course increases the level of risk. Now, if it's much lower, you might have to ask what opportunities the business may be missing out on by not borrowing more. The next ratio we'll look at is sales to assets ratio, which looks at how efficiently assets are being used to generate sales or income. Now, many businesses have significant dollars tied up in assets, and given these funds could be used perhaps for other purposes, it's important to ensure that they're being used as efficiently as possible. So to calculate the sales to assets ratio, you simply divide sales or income by your total assets. Now in Anna's case, this is $1,520,000 worth of sales divided by $660,300 in assets, which calculates out to 2.3. Again, let's apply the sentence to help tell the story. So for every dollar of assets, there is $2.30 of sales. So is that result good, bad, or indifferent? Well, for this particular ratio, that will depend on the industry. Now, some industries require a greater investment in assets. Industries like agriculture, manufacturing, and mining. Now, in which case, this ratio becomes even more important. But to understand whether this is a good result for Anna, you would need to look at benchmarks for the industry or perhaps her own past performance. The next ratio we're going to look at here measures the business's ability to turn sales into profits, the net profit margin. Now, many businesses concentrate on increasing sales. However, without ensuring that you're continuing to make the same profit margin, this would seem to be a bit of a pointless endeavour. So while we're measuring this today at the net profit level, it's also important to measure at the gross profit level. Now, this ratio looks at the amount of profit in relation to the sales made and is calculated by dividing net profit by sales. Now, in Anna's case, there is $44,900 of profit divided by the $1,520,000 worth of sales, leaving a net profit margin of 2.9%. And again, let's use the sentence to make sense of that. So it tells us that for every dollar of sales, there is 2.9 cents of net profit. Again, is this good, bad, or indifferent? Again, that will depend on the industry and the size of the business. Use benchmarks, targets, and trends to establish if the business is operating effectively in this regard. The final ratio we're going to have a look at today is the return on investment. That is, what return am I receiving on the dollars that I've got invested in my business? So this is calculated by dividing net profit by net worth. That is the amount of money the business is making divided by the owner's investment. Now in Anna's case, this is $44,900 of net profit divided by $260,100 of net worth. And this produces a result of 17.2%, which using our sentence means that for every dollar of net worth, there is 17.2 cents of net profit, or Anna is making a 17% return on her investment. So again, we ask the question, is this good, bad, or indifferent? And there's a few different considerations that come into play here. Now, similarly to the other ratios, you should check if this is in line with the industry benchmarks. See how the business is trending over time. But we also want to ask the question, what return could Anna achieve if her money was invested elsewhere? Now, the way current interest rates stand, Anna would be lucky to get a 5% return on that money in a savings account or term deposit. So it certainly stacks up in that regard. But something else to bear in mind, though, is that in the bank, Anna's money would be nice and safe, and she wouldn't be required to exert any effort at all to get that 5% return. But how safe is Anna's money in her business? Now that's what the debt to worth ratio tells us. And remember, that was 1.5, or for every dollar Anna had invested, she'd borrowed $1.50. Now, which I said at the time was a comfortable level of debt, so she doesn't have a high level of risk, but is achieving what appears to be a good return. So we've used these four ratios, our debt to worth, our sales to assets, our net profit margin, and our return on investment to measure how efficiently the financial operating cycle, or our business engine room, is turning over. But to keep our engine turning over, it needs fuel, which is exactly what cash is for a business. So keeping the working capital cycle flowing will help to fuel the engine. So let's have a look at how we can measure cash flow. To better understand how cash flows through our business, we're going to use a model called the working capital cycle. So here's how that works. So we start off with our money sitting in the bank account. However, money sitting in your bank account is no good to you. You want to use that cash to make profits. So we use this money to buy something that you can sell, like stock. Now the stock comes in, we fill up our store, our warehouse, and then of course we want to sell the stock. Once we've sold that stock, we issue an invoice and end up with things called debtors or accounts receivable. And it's only when we collect this debtor that our dollar, plus some profit hopefully, comes back to our business and the cycle is complete. Now the aim with this cycle is to keep it turning as smoothly and as swiftly as possible. Each time the cycle goes round is called a turn. We're going to measure these turns in days, because we know that days are time and time is, of course, money. Now, not all businesses are exactly the same, and the retailers out there are looking at this and saying, well, I get everything in cash and credit cards. I don't have debtors. And of course, you're exactly right. Your cycle just goes from cash in the bank to stock and back to cash again. Now, that's a bit simpler, but the premise is still the same. Turn smoothly and swiftly. Now, others of you are saying, well, hold on a minute, I'm a service business and I don't have stock. Again, I absolutely agree with you. However, you have something that acts a little bit like stock. Now, it's called WIP, or work in progress. Now, basically, you take on a job from a customer, you do all the work for them, then you send out an invoice. Now, when you're doing all that work, before you can send out the invoice, what do you have to pay out? Do you have to pay out wages? Do you have to pay out rent? And pay out your general overheads? And when you do, then it's chewing up your cash. So your cash is then further chewed up when you send out an invoice and you have to wait for your dollar to come back into the bank account. Now, no matter what it looks like, whatever business you're in, you have a working capital cycle. And it's important to understand how the cash flows through your business. So we're going to start by measuring how efficiently am I selling my stock. That is, how many days does it take to turn my stock over? Then we'll have a look at our debtors and calculate how long does it take for me to collect my debtors, so that we can see how long it's taking for our cash to flow through the business. So let's look at stock firstly, because cash tied up in stock is cash that you can't use for other things. So it's important to know how long it's going to take to convert that stock into cash. We'll calculate on average how many times a year the stock turns over and then convert that into the number of days it's taking. So to calculate the average turns per year, you divide your cost of sales by your stock. Now in Anna's case, this is 1,200,000 divided by 212,200, which gives us an average stock turn of 5.7. So Anna's stock is turning over roughly 6 times per year. Now to convert that into days, we simply divide 365, being the number of days in a year, by the number of times it turns, being 5.7. And that tells us that on average, it takes Anna 64 days to sell her stock. Now whether that 64 days is good, bad or indifferent will depend on the type of stock that it is. If it's fresh seafood, then that's probably not such a good thing. However, if it's not perishable, then again, it would depend on what others in the industry are achieving and how it compares with Anna's past performance. However, for many businesses, including Anna's, the sale is just one part of the process. She now needs to collect on the invoices that she's issued to her customers before she gets her cash back. So how long is that taking? To calculate the average number of times Anna collects her debtors in a year, we divide her sales by her outstanding debtors. Now, Anna's sales are $1,520,000 and her debtors are $169,400, which tells us that on average, Anna collects her debtors 9 times a year. So how many days is that? 365 divided by 9, of course, is 41. So it's taking Anna 41 days to collect her debtors. So is that good, bad or indifferent? That will depend on what her terms are. Now if Anna's terms are 30 days from the end of the month, then 41 days is probably about right. However, if she has 14-day terms, then 41 days collection, not so good. So in total, how long is it taking Anna's working capital cycle to turn? Well, we've got 64 days to sell her stock, then 41 to collect the debtors, which means that on average, it's taking Anna 105 days, that is more than 3 months, to turn that working capital cycle. Now, in some industries, this would not be unusual, but we would need to look at some benchmarks for the industry to determine what was acceptable. But we could also look at whether this is slowing down or speeding up compared to Anna's previous performance. Now, we will do this a little bit later when we have a look at her overall scorecard. Now, think about it though. If Anna's cash is tied up in stock and debtors for 105 days, what about all the other things that she needs to do in those 105 days, like pay her staff, pay the rent, and of course, purchase more stock? And given the fact that her sales are increasing, then she's actually needing to purchase more and more stock. But where is the cash for this coming from? Well, let's hope she's got some reserves to continue to pay her suppliers on time. Which brings us to our third measure of working capital or cash. How long is it taking to pay the suppliers or trade creditors? So let's see how Anna's doing here. To calculate the average number of times a year that Anna pays her creditors, we divide her cost of sales by her creditors. Or in Anna's case, $1,200,000 divided by $99,800. Or we can see that's 12 times a year. Then converting that into the number of days, we've got 365 divided by 12, which of course is 31 days. Again, we ask the question, is this good, bad, or indifferent? Now, if she has 30-day terms from her suppliers, then it's probably okay. But if she's not collecting from her customers for 41 days, but paying her suppliers in 31 days, then at some point it's feasible that she may just run out of cash. There seems to be a bit of a mismatch in terms of the timing of payments. Now again, if we have a look at how this compares with her past performance, we'll be able to see if perhaps these payments are slowing down because she's running out of cash. So now that we've seen how to measure how efficiently our financial operating cycle is turning and how swiftly or not the working capital cycle is turning, the next step is to put these measurements into a format that's relevant to the business so that we can assess the financial performance. Now, this could be referred to as a scorecard or a dashboard. Now, as I said at the outset, there are literally thousands of things that you can measure, but the ratios I've shown you today will help tell a relevant story about your business. They're a bit like your car's dashboard, if you like. While the computer measures hundreds of things, your dash only tells you what is relevant for you to know while you're driving. Things like your speed, how far you've gone, how much fuel you have, and so on. Now, the scorecard we've developed is a bit like that for your business. So the measure for the financial operating cycle tells us how efficiently our engine is running, and the measures of the working capital cycle tell us about our fuel or cash availability. So looking at them in isolation as they are on the screen, they still only tell part of the story. Now, you could use benchmarks to see how the business stacks up against other businesses, or look at the trends to see whether financial performance is improving or declining. Now, we calculated Anna's ratios using the first year of data out of her balance sheet and income statement. Now, on the screen in front of you, we now have the following 2 years so that we can see if Anna's performance is improving or declining. Now, we said at the outset that her sales were increasing rapidly, but that her profitability was declining. So there's a distinct possibility that her overall performance has declined. Now, firstly, her debt to worth ratio. So in year 1, we said that for every dollar of net worth, that is the money that Anna's invested in her business, she has borrowed $1.50. By year 3, though, this has increased significantly. Now, for every dollar that Anna has in the business, she has borrowed $2.68, almost 3 times as much. So this tells us that Anna is becoming more reliant on debt and that her risk is increasing. Now, Anna's assets also increased over that time, but as we can see from her sales to assets ratio, she's become less efficient in their usage. Now, in year 1, for every dollar invested in assets, she was generating $2.30 in sales. But by year 3, that had declined to $1.90. Looking now at her net profit margin, which indicates her ability to turn sales into profits. And we can see, as expected, that this has declined sharply. In year 3, she was actually only making 1/3 of a cent profit from every dollar of sales. Now, there's more bad news when we look at her return on investment as well. So while in year 1 she was making 17.2% on her investment in the business, by year 3 this has dropped to 1.75%. Now she really does need to question whether this is the best place for her money to be invested. Then looking at her working capital cycle ratios, we can see that it's taking her longer to sell her stock, longer to collect her debtors, and longer to pay her creditors. So her cash flow is suffering too. Now, while these ratios might seem to be all bad news, take heart from the fact that at least Anna is now aware of where she can make some improvements to turn her business around. So my challenge for you now is to have a look at your business through this new lens. So in this webinar, we've had a look at the financial operating cycle and the ratios to measure how efficiently the business is operating. We had a look at the working capital cycle and the relevant ratios to see how efficiently cash is being generated and used. And we put all this information into a scorecard that highlighted some areas where Anna can now implement some actions to improve on her business performance. So thank you for viewing our Measuring Financial Performance webinar. By measuring your financial performance, you're in a better position to identify positive changes you can make to improve your business. Now, I trust you found the information useful and relevant, and I wish you every success in measuring your own business's performance.